All right, class, welcome. Today we are taking a detailed look at a crucial financial planning tool, the Registered Disability Savings Plan, or as you'll always hear it, the RDSP. Honestly, this is one of the most unique plans in our entire system. It combines private savings with some really significant government support. And for any of you going into advisory roles, understanding this inside and out is non-negotiable.
Okay, let's get started.
So, here's our roadmap for today. We're going to break this down logically, following the life cycle of the plan. We'll start with the basics. What is it? Then we'll talk about how money gets in, both from individuals and from the government. From there, we'll cover how money comes out, and, most importantly for us, the tax rules. And we'll finish up with a summary of the absolute key points you have to remember.
Okay, let's dive right in. First things first, what exactly is an RDSP? I mean, what's its fundamental reason for being? Who is this plan actually designed for?
Here's the official definition, and there are a couple of key phrases I want you to focus on. First, long-term financial security. This isn't a short-term savings account. And second, and this is the most critical part, it's for someone eligible for the disability tax credit, the DTC. The DTC is the gatekeeper. You can't even think about opening an RDSP for someone unless they're DTC eligible, period.
So, once we've established eligibility, how do we get money into this thing? Well, like any savings vehicle, it all starts with the contributions. We need to get the rules for putting money into the plan straight before we can understand anything else.
Okay, if there's one number you write down today and circle a few times, this is it, $200,000. This is the lifetime contribution limit. It's not an annual limit, it's the absolute maximum amount of private money that can ever be put into an RDSP for one specific beneficiary over their entire life.
Now let's get into the nitty-gritty rules, and these are important. First, and this is a big one to remember, contributions are not tax-deductible. This is not an RRSP. You're putting in after-tax dollars. Second, there's no annual limit. You could technically put in a huge chunk at once, but as we'll see, that's usually a bad idea. These contributions have to stop when the beneficiary turns 59. And here's the payoff for not getting a deduction up front. When that original contribution money is withdrawn, it comes out completely tax-free.
Now, if the RDSP was just about private contributions, it would be a decent plan. But this next part, this is what makes it a total game changer. The private savings are only half the story. The real power comes from the federal government's involvement.
So the government kicks in money in two different ways. On the left, we have the Canada Disability Savings Grant, the CDSG. The easiest way to think of this is as a matching program. You contribute and the government adds money on top of it. On the right, you've got the Canada Disability Savings Bond, the CDSB. This one's totally different. It has nothing to do with contributions. It's based entirely on the family's income. Just look at those lifetime limits, up to $70,000 in grants and $20,000 in bonds. That's a potential $90,000 of what is essentially free money. The key date to remember here is that both of these stop once the beneficiary turns 49.
So, let's really simplify this. The grant is all about encouraging savings. It's a reward system. You put money in, the government puts money in. The bond, on the other hand, is pure social support. It's income tested, designed to help build savings for those with lower incomes, even if they can't afford to contribute much themselves. Two different tools, one common goal.
All right, we've put money in, the government has generously kicked in more, and hopefully it's been growing for years. Now we get to the part that really matters to us as tax professionals. What happens when it's time to take the money out?
You have to know these three milestone ages. They dictate the entire life cycle of the plan. Age 49, government money stops. Age 59, your money stops going in. And then at age 60, the plan flips from a savings vehicle to an income vehicle. Regular payments, called Lifetime Disability Assistance Payments, or LDAPs, have to start.
And here it is, the central question for any tax student looking at this plan. It's not as simple as a TFSA, where nothing is taxed, or an RSSP, where everything is taxed. The RDSP is a hybrid. So how do we figure out what portion of any given payment is actually taxable?
The absolute best way to visualize this is to imagine two separate buckets of money inside every RDSP. Bucket number one holds all the personal contributions, the after-tax money that was put in. When money comes out of this bucket, it's a return of capital, so it's 100% tax-free. Bucket number two holds everything else, all the government grants, all the government bonds, and every penny of investment growth. When money comes out of this second bucket, it's fully taxable in the hands of the beneficiary. Every single payment from an RDSP is just a prorated mix of these two buckets.
Okay, that was a lot of information. Let's distill it all down. If you walk away from this lecture remembering only one slide, make it the next one. These are the non-negotiables you have to know to advise a client properly.
So here's your cheat sheet. First, know those lifetime limits like the back of your hand. Second, never forget contributions are not deductible. Third, remember that two-bucket system, that every withdrawal is a mix of tax-free and taxable money. And finally, and this is so important, the tax is paid by the beneficiary, not the parents or grandparents who might have made the contributions. The income is attributed to the person with the disability, which is often a very good thing from a tax planning perspective.
So at the end of the day, you can't just think of an RDSP as a savings account, and you can't think of it as just a government benefits program. Its real power, its true genius, is in how it blends those two things together. Your job, as an advisor, is to help clients use their private savings to strategically maximize that government support.
I'll leave you with a final thought to consider. Take a step back from the numbers and the rules for a second. What does the very structure of this plan tell us about Canadian policy? It's really a fascinating model that tries to encourage personal responsibility while also providing a very strong social safety net. It's much more than just a chapter in the Income Tax Act. It's a statement about our society's values. Think about that. Thanks, everyone.